Bigger picture now, we bring in Chris Wolfe. He is Chief Investment Officer at Merrill Lynch's Private Banking and Investment Group. He helps oversee $157 billion in assets. So welcome to the Close on Street Smart. Chris, thanks for joining us. Let me get your take first on earnings. We heard Andrew kind of wrapping him up. He, of course, is down there in the pits. It's a daily game for him. He wants to be in and out in less than a trading session or a couple trading sessions. You obviously are going to take a longer view for your clients.
Yeah, I think a couple of things. First is you've had several quarters, in fact, by my count, 7 or more, of earnings beats. Surprises, if you will. So I think people are becoming a little more inured to the game. Second is that the rate of beats has actually started to slow a little bit. We've had revenue lines and earnings lines that have come in better than expected, but not as great as some people had originally estimated. So
well, I think, and a big disappointing miss at Google, right, which a lot of people seem to have forgotten.
Yeah, a lot of pressure was placed on the technology sector because that's been a huge source of net income and earnings growth for the S&P over the last several quarters, and the expectation is it's going to carry through 2011. So energy's been the big driver since 2010. That's starting to fade a little bit as oil prices may be peaking. I think the reality here is financials and technology are going to have to pick up a lot of the slack to make the numbers close to $95 this year.
You know, Chris, there's been so much focus on revenue in the past few quarters because obviously you can massage the bottom line. It's a lot harder to do on the top. But it kind of reminds me of the beginning of the tech boom when chief investment officers or CEOs were saying, hey, we're just ramping up the revenues here. It doesn't matter if we make any money. Margins do matter, though, right now, don't they?
Totally agree. We're at the peak, at least a relative peak in profit margins in our view. We've seen a lot of companies maintain their cost structures at a very efficient level. What that really means is they haven't been hiring. Bottom line is the profit lines look pretty good, and companies don't need a lot of revenue line to generate a lot of earnings growth. That's the first thing. The second is this has been an industrial kind of investment-led recovery with business spending, cash on balance sheets being put to use. It's really not led by the consumer. That's only just started to pick up. So at the end of the day, the transition from an investment-led recovery to consumer spending is really what we got to see for sustained growth going forward.
One concern, by the way, when companies are taking a look at their margins, commodities prices. And Dom, where do we see that? I mean, the case may not be a straight line up anymore as it once was. Some traders are looking towards signs of a pullback, right?
Yeah, they are. They're looking at something called the Relative Strength Index. Now, that's just a fancy way of saying how much momentum is there behind a particular stock or asset class. Take silver, for instance, here. This number, all right, is 90 right now. Just to give you an indication of what that means, when the number goes above 70, traders say that a stock, asset, something is near an exhaustion point or is near a high enough price where it may correct. That's something they're keying on. Number two, just an interesting tidbit about volume, guys. I want to bring this in because Joe Saluzzi over at Themis kind of talked a little bit about this today. The S&P 500 ETF, the spider, so to speak, has traded 60 million shares today. The one that tracks the Russell 2000, about 20 million. Same thing with the one that tracks the NASDAQ 100. Altogether, 100 million shares of volume. Guess how many shares the silver ETF has traded today, guys? Almost 200 million shares today. So just something to throw out there, guys.
I'm glad he didn't make us actually guess because he would have been putting us seriously on the spot. But obviously, silver's been on a tear. Even if people are looking for a commodities pullback, they have been on fire lately, pretty much across the board, right? And you guys like metals and mining companies.
Yeah, that's right. I think we're looking at the commodity sector in general as being constrained by capacity, hard to start a lot of new mines. And two is the demand is really coming from emerging markets, as we've seen over the last several years, and now starting to pick up with the resurgence in the developed markets, U.S., Europe, et cetera. So that combination of constrained capacity and high demand has really pushed, or rising demand has pushed prices up. And at the end of the day, it's caused analysts to revise up their forecast for earnings. And they've been chasing these companies up over the last 7 quarters or so. We may be getting to the end of that cycle, but I think for now, at least through the summer, we continue to expect M&A, which has been a big driver for returns in the short term, to continue helping to propel these stocks.
You also like consumer staples. And I noticed when the economy's on the up and up, guys like the consumer discretionaries, the luxury stocks, right? If we slow down or there's a downturn, that's when people get into consumer staples. Is that a problem? Are you concerned about the economy here?
It's a little bit of a contrarian call. So we like the technology names as well. That's done very well. Energy has done well. I think some of the industrial cyclicals, that's part of the industrial cycle we talked about. I think the consumer staples call is really anchored on two things. We're seeing food price inflation. Companies are absorbing that margin now, but eventually they tend to pass it along. And two is we tend to look at these companies with their steadier growth rates and their pass-through of earnings in the form of dividends to investors as being a good place to consider balancing out part of their equity portfolio.
Consumer discretionary
I think it's a bit more challenging at this point. A lot of good news is baked in here.
You know, when you look at the economy and what's going on, and consumer staples obviously brings up the concern about inflation, right? A lot of people are saying that we're going to inflate our way out of all the debt problems that we have. Some people are actually prescribing that. Do you think it's inevitable?
You know, it's been the history. If you look at studies by the IMF, you look at Reinhart Rogoff's book and other types of, let's call it empirical studies, data-driven studies, where you find inflation has been a way out. I think at the end of the day, some form of that, meaning inflation, but also a combination of higher taxes and reduced spending is also a way for us to really get the debt and deficit picture under control, because that's the key here. Lots of debt and deficits get to the inflation problem. Let's go to the root first.
You know, let's go to Netflix earnings right now. They just came out across the wire here. I'm seeing the trade here. It looks like EPS $1.11, better than the estimate. So another tech beat there, Jules. You looking at Netflix?
I am looking at Netflix. In fact, it looks like the shares are down at first blush. So to run through some of the numbers here, first quarter earnings per share, as you said, a 4-cent beat here. The company's coming out with the second quarter forecast, and it looks like that is short of estimates. So the second quarter earnings per share forecast coming from the company, 93 cents to $1.15. Analysts have been looking for $1.18. So it does look like some disappointment there. Also, if you look at the second quarter domestic revenue forecast, it looks like that's $762 to $778 million. 767 was where the revenue forecast from analysts was. But so it looks like that in particular, the earnings forecast for the second quarter is disappointing. Some other numbers that we have here is the company talking about subscribers domestically, additions of 3.3 million. In the second quarter, the total subscribers should equal 24 to 24.8 million here. So getting some numbers both on subscribers and on numbers. But again, the shares are down. Could be that disappointing second quarter forecast, Matt.
You know, Chris, let me come back to you on this. I mean, we've seen expectations for a tapering of the earnings growth this year. Obviously, it's been so hot since they came from such a trough before that it's hard to continue putting up those kind of big numbers. In tech, is it a different story? I mean, in tech, can you still see the kind of growth that we've been seeing over the last year?
Yeah, the big driver for the S&P broadly has been finance and energy. Those have been the big explainers of the recovery in profits from the low in 2008. We've seen technology actually start to pick up a lot of steam as companies have started to reinvest the cash balances. We've had a number of years, 5 if you by my count, of underinvestment in technology. We've been through a depreciation cycle, and so I think there's room for companies to be spending their capital on all sorts of things, namely M&A, which we've seen, but also technology and upgrades. And that has some labor dampening effects, meaning the more you spend on technology, the less you're going to be hiring lots of new people, maybe some. But the bottom line is we do see that spend happening, and we think company revenues, at least in the technology sector, are going to show it.
Great, Chris. Thanks so much for joining us. Chris Wolfe, Chief Investment Officer at Merrill Lynch, Private Banking and Investment Group. We're going to